Hello and happy 2023. This is Noel Lim on ASEAN Speaks by Maybank. This year is predicted to be of two halves, volatile in the first, recovery in the second. Another possible scenario is permacrisis or permanent crisis continuing from last year. The silver lining is China has relaxed its COVID restrictions, but infection rate is high at the moment. To tell us how we could position our investment portfolios is Chan Han Chin, portfolio strategist at Maybank Investment Bank. Thank you for making time for me. What is your outlook for equities in 2023?
After a bad year last year, we think that this year will be better, and we are more positive on emerging markets as compared to developed markets. We prefer Asian equities, especially Chinese equities, and we think that Asian equities will be led by a Chinese recovery, and that will be due to a relaxation of COVID-0 policies and certain measures being introduced to help stabilize the property market. And in terms of ASEAN markets, we think that it will continue to offer a defensive option for investors, while at the same time also offers good growth opportunities. And on the other hand, in US, we are seeing that the risk of persisting inflation to continue to drive volatility in equity markets, and that will mean it will be uncertain in terms of the timing of a Fed pivot, and or in other words, when will Fed starts to reverse its monetary policy stance. However, in terms of valuations, we do take note that if we look at compared to the dot-com bubble period, currently valuation is close to that levels when market bottom out after the dot-com crash. This is for S&P 500 specifically. To conclude, we think that Asian equities will hold up better this year as compared to the developed markets.
How best should investors then position themselves given there's this possibility of two halves or maybe a year of quite similar volatility in 2022?
Given either of the scenarios, we still think that investors should stay invested in the market, but perhaps be a little more selective. What we like are companies which utilize reasonable leverage, means the debt to equity ratio is not that high, while at the same time being able to deliver persistency in terms of earnings. These companies are ASEAN stocks, which are consumer focused, and they are also their business are mostly domestic basis. In terms of sector, it will be consumer staple sector. We also like stocks which can offer good dividend yields, and some of these sectors are utilities and telco names. Another way to also maybe position themselves in the event of maybe a further market correction, try to pick value stocks and try to buy on dips in value names. And we think that Chinese stocks are still attractively valued even after the current rally. Financials and energy, they are still attractive. Financials because they are also sensitive to the economic growth, and energy could be a good inflation hedge in the event that inflation turns out to be persisting longer than expected.
Could you please share some stock names with us that investors could look into more closely?
In terms of stocks, I think in terms of Chinese stocks, there are a number of them in our model portfolios. So this would include names such as Bank of China. And if you look for maybe domestic focused names, I think Malaysia, there are quite a number of names that we had in our model portfolios, such as RHB, AMB, Alliance Bank, quite a number of those in our portfolios.
Banks are still very much in favor.
Banks is because of course, they are value names, and also they offer quite attractive dividend yields.
I would like to deep dive further. You are anticipating good risk reward for Malaysia, the Philippines and Vietnam for their undemanding valuations. So let me start with Malaysia first. How much does this hinge on the political factor?
Yeah, because Malaysia, if you look at it, before the general election, we have an extended period of political uncertainty. Investors were significantly underweight on the market. But what we observed after the polling date, even though we had the first hung parliament in Malaysia's general election history, but the market did not actually drop much. And a few days later, once we had a unity government being formed, there was a massive rally in the markets. So we think that right now, maybe we are likely to be in a consolidation period. But as you said, with the political uncertainty perhaps subsided, investors could focus back on earnings. And if you look at third quarter earnings, Malaysia companies, there are more companies which deliver earnings which beat estimates as opposed to those which underperform the estimates. And this basically coupled with a stronger MYR towards the end of the year last year and persistently high energy prices as compared to a number of years ago, this would be some tailwind that could perhaps help the market into 23.
For the Philippines, what will continue to drive this equities rally that we are seeing now?
Philippines, we are looking at it from more of a little more on a tactical perspective, because the fact that last year it has suffered the most in terms of ASEAN markets after Vietnam, perhaps. That was due to a strong US dollar and also aggressive interest rate hikes by the Central Bank of Philippines. But I think this year we have already seen the worst of the peso drop last year, and aggressive rate hikes are also expected to pause this year. So as one of the fastest growing nation in ASEAN, is actually the second fastest growing nation in ASEAN after Vietnam. So valuations is actually quite attractive, at least from a tactical perspective.
As for Vietnam, we had expected it to be the star last year, but the markets were rocked by scandals. It seems to me Vietnam is a long game, and until they get upgraded from frontier to developing market status, I think investors have to be very patient. How will you position our Vietnam model portfolio?
One interesting thing with Vietnam is we have never seen the market traded as cheap as currently. So it's trading at about, I think, 11 times forward PE. And of course, the poor performance last year was due to many of the factors, interest rate pressure, the weakness of the dong, and also the anti-corruption crackdown had an impact on the corporate bond market as well. As you said, Vietnam is a long game, but I think it pays for investors to invest when the valuations are depressed, but maybe have a longer time frame in mind. Because as a frontier market, I think once the sentiment has already been hurt, it will be a little tough to recover as quickly if you compare to the developed markets. Yeah, so in terms of positioning for Vietnam model portfolios, we prefer companies with low leverage, which have a low debt to equity ratio because they are less risky companies. And also these stocks should be able to deliver earnings which are more certain in the future. And for this, we recommend investors to look at our quality model portfolio to weather the potential longer downturn in the Vietnamese stock market.
And would this be mainly comprising banks?
A mix of companies, banks, and consumer staples are also one of them.
What interests me is your Thai model portfolios. They outperformed the other regional portfolios in 2022. What were the qualities in the portfolio construction process that helped the performance, or did the portfolio ride on the tourism recovery narrative?
As you said, it did ride on the tourism recovery, because what we observe is for China, there's a relaxation of COVID-0 policies, and this has actually helped Thailand to outperform the other stock markets in the last 2 months of 2022. And actually, as far as 2022 is concerned, Thailand MSCI performance is concerned, it has also outperformed many other regions and countries. And of course, you see that due to the relaxation of COVID-0 policies, Thai baht has recovered. And then this also you are seeing even throughout 2022, Thai has enjoyed strong foreign inflows. Of course, another aspect is in terms of our portfolio construction process, it is two-step process. So we have the first cut, which is a quantitative screening, which will try to screen out stocks which are attractive in a quantitative manner. But then we have a second step, which is analysts on the ground to try to pick the most fundamentally sound companies to try to ride on the recovery. We think that these two steps will actually complement each other, because quantitative investing, it could reduce the emotional bias, which is one of the common pitfalls in investing. And then the second step is have analysts on the ground, because these are the people who can perhaps pick up the stock-specific factors, which normally cannot be picked up by just looking at numbers alone. And this factor usually things like management quality.
Given the variety of model portfolios that your team has constructed, including for US stocks and also based on your analysis, this two-step process, which portfolios should our clients or investors look into more closely in at least the first half of this year?
Yeah, we think that investors should still stay diversified. And for investors who don't mind being invested in different geographical region, such as US, Hong Kong, China, and also ASEAN stocks, I think they should take a look at our international quality model portfolio. It is a portfolio which invests in stocks with low leverage and also persistency in earnings. And some of these stock names, they also offer good dividend yields. And the sectors will be a little more defensive, as one of the main sector is the consumer staples sector. And because we are also more positive on Asian equities, if investors like a more Asian-centric model portfolio, we would recommend looking at our international balanced model portfolio, or also a value model portfolio would also be good. For the balanced model portfolio, it has a good mix of different sectors. So you have sectors such as financials, real estate, and materials, which are sensitive to the economic recovery. And you also have names such as in the healthcare and consumer staples sector, which are defensive, so that you can ride out the global downturn. And for the value model portfolio, it will be a little more concentrated. The portfolio will be more concentrated in names such as Chinese financials and also energy stocks. And Chinese financials, of course, they are sensitive to the economic recovery. They offer very high dividend yields, while energy stocks, they offer a good inflation hedge. Our conclusion is to be well diversified geographically, because if we look at last year as an example, some of the markets which were expected to perform strongly, they turned out to be one of the worst performers.
What about tech names? Should we still stay away from tech for now?
I think, in my view, will be a little more neutral. Tech sector, you can have Chinese tech, you can have US tech. I would prefer Chinese tech as compared to the US tech. And of course, this was due to the underperformance witnessed from the Chinese tech sector, which brought the valuations down significantly to some of the names even appear to become like value stocks instead of growth stocks. But in terms of the US tech sector, maybe we still try to stay a little defensive in terms of US tech sector, perhaps concentrate on names which are of higher quality in nature. And maybe one of the stocks that I would still be positive on in terms of the US tech sector would be Microsoft.
Han Chin, great speaking with you as always. Chan Han Chin, portfolio strategist at Maybank Investment Bank. To find out more about our model portfolios, speak to a Maybank Investment Bank trading rep or contact our sales desk. I'm Noelle Lim on ASEAN Speaks by Maybank.